For most business owners, there are essentially 4 types of retirement plans that you can get involved in. If you have a multitude of employees and you are interested in contributing and participating and really socking away large sums of capital each and every year, if again, you qualify, that's the traditional 401k plan, right? A 401k plan gives you the ability to put money away each and every year. This is what is sometimes referred to as an employer-sponsored plan. And currently, you're able to, as an employee, contribute up to $23,000 into a 401k plan. And then your company can match or give profit sharing contributions to make the maximum contribution up to $69,000 per year. Now, I'm not talking yet about the tax deductibility of that type of contribution. I'm just talking about the dollars in. So inside of a 401k plan, a traditional 401k plan, the maximum that can go into that plan is $69,000. If you're over the age of 50, you have something called a catch-up contribution, which gives you the ability to put in an extra $7,500 per year. It is a way to actually put a lot of money into a plan, a pool of money that can be used for supplementing your needs post the financial independence date. Again, we're not talking about tax deductibility yet. I'm just talking about the dollars you can put in. If you are a business owner that does not have employees, meaning you're a solopreneur, or maybe you and your spouse are working in your company, you can take advantage of a similar structure of the 401k, but in what's called a solo environment. That is referred to as a solo 401k. And again, the same dollar thresholds are permitted. A maximum of $69,000 can be contributed into that plan in 2024 with an additional $7,500 of what's called a catch-up contribution, which is an additional amount of money you can put in if you're over the age of 50. Here's the rub. With a 401k plan, you are required to test that plan to make sure that you are not adversely impacting other employees that you may have. If you want to participate in a 401k plan and you do have employees, you have to test that plan to make sure that you are not putting too much money in relative to your employees. And that process is referred to as making sure the plan is not top heavy. There are 2 general types of 401k plans. There is what is referred to as traditional, which gives you a tax deduction for putting the money into the plan. That is the traditional deferral type plan, right? I'm deferring my tax burden to the future. So I'm going to put money into a traditional 401k plan or a traditional solo 401k, and I'm getting a tax deduction this year for doing it, and I'm pushing off the tax burden in the future when I want to pull money out of that plan at some future date. The second type of plan in the 401k environment is referred to as a Roth 401k or a Roth Solo K. The Roth gives you all the same limits, right? The $69,000 maximum contribution plus an additional $7,500 if you're over the age of 50, but you don't get a tax deduction for putting the money in. However, while the money is in the plan, it grows tax deferred, meaning you're not taxed every year as it grows. And when you take that money out during your financial independence period, there's no income taxation. After tax going in, meaning you don't get a tax deduction for putting the money in, but when you pull that money out in the future, it is tax-free. This is referred to as a Roth 401k or a Roth Solo 401k. Both of those plans require you as the business owner to be an employee of your business. So if you are an employee of your business, you can participate in an employer-sponsored plan. Now, there are 2 other forms of retirement plans. Now, these forms do not have a Roth component. So these forms are only for tax deferral, meaning the money you put in, you get a tax deduction. The money you take out will be income taxable to you in the future. The first is what is referred to as a simple IRA. This is typically going to be put in place if you have just a few employees. And the reason why it gets put in place is it gives you the ability as the employer to make a contribution. It also gives your employee the ability to make a contribution, a deferral. Plus, as the employer, you get to match a certain amount of money that employee is contributing, up to 3% of the amount that they contribute. So you're sort of giving them a bonus for participating in the simple plan. The thresholds of the amounts you can put in are way, way, way lower. As an employee, you could only put in $16,000 in 2024, with an additional $3,500 if you're over the age of 50, and the employer can match up to 3% of that amount. So it's a much, much lower amount of money you can put in, but it is simple in that there's not any testing that you have to do. There's no additional reporting that you have to be engaged in order to implement a retirement plan called a simple IRA. Now, if you're interested in putting money away, not inside of a 401k and having an ability to contribute a little bit more, well, then you're talking about something called a SEP IRA, a self-employed pension, essentially. This type of plan gives you the ability to contribute up to 25% of your income. Here's the problem with the SEP, though. If you have employees that are full-time employees working more than 30 hours a week, and they've been with you for a year, you're required to contribute on their behalf as well. So this could be a costly program for those of you that do have employees. So when we're looking at this dynamic of these different types of retirement plans that a small business owner can engage in, they typically fall into those four categories, two of which are in the larger employer-based plans, right? The 401k, or the solo 401k, or you're into the IRA realm, the simple IRA or the SEP IRA. On the IRA side of the spectrum, they are not complicated. They are very, pun intended, simple plans. They're not complex. On the 401k side, there's testing that's required. There's an opportunity where you have to make sure that what you're doing is not disadvantaging any of your employees if you have them. All of the things that I shared with you, there's costs associated with. Those costs are business expenses that are legitimately business deductions. The 401k side of the spectrum of all the plans is going to be the most expensive for you to implement because there are annual filing fees of a form called the Form 5500, which is your testing form. You're going to pay a fee to file that every year. You are also going to have administrative costs associated with the plan itself. Those are typically charged to you by a financial institution like a Fidelity or a Vanguard or whomever you establish your 401k plan with. And then you're going to have expenses as a participant in the plan, which is the underlying investments, right? Each underlying investment you participate in is going to have a cost that is associated with it. So that's going to eat into your investment returns, right? Because those expenses are referred to as an expense ratio, and they reduce the amount of return that particular investment has. If you had an expense ratio of 1% and your fund returned 4%, you would net 3% because the expense comes right off the top of that particular return. But here's the thing, if the returns are negative, you're worse off because even at 0% return, if you had a 1% expense ratio, that means your portfolio would return negative 1%, right? You would have lost money, even though the fund itself didn't lose money. So you have to be very, very mindful of actual costs when it comes to your investments that you're engaging in. But here's the interesting thing. When we're talking about the 401k side of the spectrum and the IRA side of the spectrum, there is an opportunity for you to not use traditional investing. You can seek out what is referred to as a self-advised and self-managed custodian. That concept of self-directedness gives you the ability to push a retirement vehicle to a particular type of custodian that will allow you to invest the amounts that are in that plan in alternative ways. So instead of with Wall Street, you can use those funds to buy businesses, to invest in cryptocurrencies, to buy real estate. You can use the funds inside of a self-directed retirement plan to invest in alternatives to traditional Wall Street, mutual funds, stocks, bonds, etc. You can invest in these alternative asset classes. You can simply go into Google and type in self-directed IRA or self-directed 401k. You'll find a list of custodians that permit self-directedness inside of retirement vehicles. Now, there's a cost to doing that, right? Every custodian is going to have different types of costs that are associated with them. So I would advise you to really start to lay out and get an understanding of what those costs may be so that you don't necessarily cut your nose off to spite your face, because expenses are a form of leakage when it comes to profit. Profit leaks are real. They erode your progress towards real wealth creation. If you're leaking too much of profit due to excessive fees, you're putting yourself at a disadvantage in the journey to financial freedom. So we want to make sure that you take control of that by ensuring that you know and understand the fee structures that are associated with the things that you're involved in. So self-directed custodian is what you'd be looking for if you're interested in taking advantage of a retirement vehicle to invest in things that are non-traditional, that are not the average when it comes to Wall Street and how Wall Street chooses to do things. Because when you're looking at your financial future, one of the things I want to make sure that you're doing is that you're looking at it with an eye towards objective. What is your financial independent state? What are you trying to achieve? And how much do you actually need to be financially independent? Remember, when I talked about this formula for financial freedom, free cash flow greater than your daily needs and wants, those 10 words, I'm talking about your earn rate above your burn rate. That excess is financial freedom, but we need to calculate what that is. So in order to do that, you need to calculate your burn rate. How much is it that you're spending? How much is it that you need to support the lifestyle that you desire? Like, how many of you have ever calculated that? Like, sat down and actually looked at how much money am I spending every year? And then once you have that number, figure out what's going to be necessary for me to essentially replace me trading my time for $1. See, so many business owners, and again, this is not your fault, we get roped into this concept of business ownership because we believe that it's going to give us freedom, but business ownership by itself doesn't give us freedom because most of us are not really business owners. We're job owners, and lots of jobs. How many people can relate to that? How many people can relate to this concept of not necessarily being a business owner, but rather being a job owner, wearing multiple hats? And the reality of that means that we're constantly in our business. We're constantly doing something in our business. And because of that, we are trading our time for dollars. So what I want to understand is, what is the amount of dollars I need to live a lifestyle of financial freedom, and then reverse engineer the steps of asset acquisition to replace myself doing the thing in business.